From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, September 6th, and it's our favorite Friday of the month. It's a non-farm payrolls jobs day Friday. Always a big day here. We never really do it with champagne, but we should maybe think about libations in the future. Great day. So we had the numbers just a little while ago. The headline numbers are 130,000 payrolls, unemployment rate holding steady around 3.7%, and I think those numbers are going to dominate a lot of what we talk about today on the Macrocast. I'm Tony Fratto with Hamilton Place Strategies, John Fagan and Brendan Walsh with Markets Policy Partners. And Brendan, why don't we take a deeper look into the numbers?
Yeah, this one was very interesting. It was almost kind of a choose your own path. If you wanted to see the positives on this, you could take that path. If you want to see the negatives. Just kind of as a little background for the listeners, when we get the jobs data, it's actually two different surveys. So the household data is where we get the unemployment rate. So that is the BLS picks up the phone and emails just regular people and say, are you employed or not? And that one's actually huge. That's hundreds of thousands of people. And then we get the establishment data, which that's the jobs number that you kind of hear quoted on the news, 130,000. And that's actual, the BLS reaches out to individual companies, and they reply and they say, we hired 12 people. The BLS aggregates it all up. But that's actually a much smaller survey in terms of the size of it. So both of them have interesting underlying data points. So the establishment data today said that we created 130,000 jobs. It was really actually more like 105,000 jobs because we're in the process of doing the 2020 census. So the BLS, or the Census Bureau, is hiring people just on a part-time basis. So they hired 25,000 people. So this jobs number is actually much more like 105,000. That's what the market's
so 25,000 jobs. It does show up.
It shows up. Right? And they're real jobs. You get paid.
Yeah, they're real jobs. They're temporary. So they'll go away.
It's usually about a 6-month process.
What I don't understand, look, it is like we call it, this is non-farm payrolls. The reason we do non-farm payrolls is because farm employment is seasonal and moves around and goes up and down depending on what you happen to be planting or harvesting on any given month. So they X out farm payrolls, and everything else is more or less steady. But there are seasonal adjustments that they do, things like holiday hiring and other ways they try to model to account for temporary surges. I don't understand why they sort of like everybody knows that the census was going to be hiring 25,000 people. Why do we have to go through this explanation?
Yeah, it's very confusing and pretty silly, but that's where we're at.
I will say that and it's confusing sometimes. Just as a reminder, this is the very best job counting service in the history of mankind. It's it's pretty impressive what they do on a regular monthly basis.
Yeah, the U.S. number is so much better than everything else. Like the level of error in Canada and Australia is hundreds of thousands, and ours is about 70,000, which is pretty impressive for
a much bigger.
We have 300 million people. You know?
Okay, so the numbers. Yeah. So about 105,000.
The establishment was kind of weak. If you want to focus on the negatives, that's where you're going to focus. Where we had 20,000 in the last 2 months. The revision showed 20,000 less jobs. And then in terms of the average, so back in 2014, we were creating about 240,000 jobs. That was down to about 183,000 jobs in 2018. And now in 2019, so far, we're at 129,000. So that's a pretty substantial slowdown.
It is. I think, some of the initial reactions were that, the number missed private sector forecasts and by some, but I have to say, I look at it and I think this is the 107th consecutive month of job growth. That is really, really long. That's basically a long run.
I think maybe in the 60s we went by, but I think this is the longest. Yeah.
So, and we're at 3.7% unemployment rate. Labor force participation is in a pretty good place. Not where it was at its historic highs, but there are demographic and structural reasons for that. We may never see those heights again. So, like, it's a pretty good number for like this late. I mean, at some point you kind of run out of workers. In fact, I mean, our friend Josh Barrow, tweeted out a question a little while ago saying, or maybe it was Joe Weisenthal, tweeted out a question saying, where the hell did the census, find 25,000 workers just like that who are willing to go work? And I thought about it. That's a pretty good question. Like, where do you go find those workers?
And that goes back to, if you wanted to focus on the negative, you focus on the establishment data, and it's specifically if you're worried that the trade war is slowing down the economy, you take a look at the manufacturing jobs. So in the first 8 months of 2018, we created in 2019, we've only created 44,000 manufacturing jobs. In just November and December of 2018, we created 47,000 manufacturing. So you're seeing weakness there. But now if you go to the household data, which that is the data which we create the unemployment rate, which held steady at 3.7, which is at historical lows. The civilian labor force, this is the amount of people that are in the labor force, expanded by 571,000. So we have 164 million people in the labor force. The number of employed people, so you called, these are employed, that increased by 590,000. And the number of unemployed decreased by 19,000. So that survey is showing very, very strength in the economy, and also the number of people that said that they were not in the labor force decreased by 364,000. So that's showing extreme strength. And then from that SAFE survey, we get the wage data, which increased on a month-over-month basis 0.4% above expectations, and that puts it at 3.2% year over year, which is pretty close to our cyclical high. And more importantly, it had a very tough base effect. Yeah, right. So it was, on the year over year, it was going to be tough. People thought it was going to be about 3%. So this showed a lot of strength. And actually in the last 3 months, if you analyze what we've done in the wage, we're running at 4.7%.
Yeah, so pretty good. So pretty good news there. And there's no reason why the consumer, we should have any fear for the near term where the consumer is going to go away. It seems like the consumer.
And I would say that if this report came out and we were not in the midst of a trade war, economists would say this is pretty good. Yeah. It's a normal report for where we're in, within a 10-year economic expansion. Yeah. But since we're worried about the trade war, this showed some weak.
Yeah, still some sectoral weaknesses, rather. So you mentioned manufacturing down, some of that in mining. I think had a
and then retail trade is still disaster.
And retail still,
but that has.
I think we've seen every single month this year has seen declines in retail employment.
Yeah, and this month we lost another 11,000 jobs in the and it's the box and mortar jobs that are disappearing.
Yeah. How are markets consuming it?
Yeah, from a market's perspective, it really didn't change the narrative very much. We've had pretty consistently solid non-farm payrolls as we've just discussed. The labor market has seemed pretty tight. And the big market, the non-farm payroll is obviously the granddaddy of all economic numbers. It's the showstopper so
Big
often.
Bertha.
Yeah, right. It's a major market mover on a regular basis historically, but its impact on markets recently has been somewhat deadened by the fact that the Fed, particularly not everybody on the Fed, but Chair Powell and a bunch of the other Fed leadership have specifically downplayed the importance of tight labor markets in their policy setting decisions over the last few months. Jerome Powell has said over the summer that the neutral rate of unemployment is obviously lower than where they thought it was going to be, and he's downplayed the strength in these numbers as something is affecting their easing cycle, and he's clearly shifted his focus decisively, and the focus of the committee decisively, toward manufacturing specifically, and you can definitely cherry pick the weakness there. And we saw a pretty weak ISM, the manufacturing activity gauge for the U.S. for August slipped into contractionary territory unexpectedly earlier this week, and that's pretty consistent with what we've been seeing. This trade war engendered weakness in manufacturing specific. And the Fed is focused on that. The Fed is focused on overseas weakness, and we haven't seen anything to change the narrative on that. The numbers out of Germany have looked awful this week again. And they are focused on inflation. We get an inflation number next week, and we'll talk about that later. But they're focused laser-like on their core PCE, their pet measure of inflation. So,
and they're not seeing any. Not seeing it there. I mean, I saw this. Let's talk of the the Phillips curve and waiting for wage price inflation, waiting for wages to push in inflation is looking like waiting for Godot.
Right.
It's right. Has never showed up, and theoretically it ought to in some way, but if you're not seeing it,
right.
You have to question whether you should believe in it.
Right. If the Fed were traditionally data dependent in the way that they used to be, and labor was one of the, if not the leading thing they looked at, this might be more of a market moving number. We've seen Treasury yields pop up this week as some of I mentioned the weakness in the manufacturing gauge for August, but a lot of the other data, particularly the data that came in yesterday, looked pretty good. Yeah. And with durable goods orders, factory orders, a privately compiled jobs measure, and combined with some other factors which we'll discuss, we've seen Treasury yields pop off their recent lows, and they aren't really retracing that move today on the back of this number. They're holding pretty steady.
Yeah. Now, if they if someone caught wind that the Fed was not going to follow through with a 25% basis cut in September later this month, that would move markets.
Oh my God.
Oh yeah. And we would get, and we've talked a lot here about the yield curve, the differential between yields in the two-year yield and the 10-year yield, and how that inversion with the 10-year yield below the 2-year yield is a ominous signal of impending recession. Well, we're out of that now. It's popped up, and the 10-year yields are trading back above. Now, if the Fed started to get cold feet about its
later this
loosening
afternoon,
cycle,
Chairman Powell is going to speak.
He's that's
the last time we'll basically hear from him.
Where is this? He's speaking. He's got to talk somewhere else in the world, I think.
Oh yeah, he is abroad.
Yeah.
But if he was to send the message that we're on hold, holy moly, we're going to have a busy afternoon.
It does. I mean, you do look at these numbers that again from traditional, sort of traditional data, like John said, traditional data dependent. Yeah. We should not be talking about a rate cut in September, but
and actually, I was just looking at the data here. You made the good point about demographically adjusted it. So the labor force participation rate in the 2000s and before the Great Recession in 2007 was about 66%. Right now we're at 63%, but when you adjust it for the aging of the baby boomers, we're back to where we were the last two.
Yeah, exactly. Age baby boomers, and then there's something happening with women, right, who are sort of just structurally, for whatever reason, are
participating less than their baby boom mothers. Yeah.
It has little to do with the business cycle. It's more of a cultural lifestyle decision that you're making. Yeah.
The other interesting, this has nothing to do with necessarily this report, but I saw a map of the United States, and it had the largest employer in every state, and basically every state outside of Appalachia and the Deep South, your largest employer is either the main university or the main hospital system. And in Appalachia and the Deep South, it's Walmart. So you have to think that has an effect both culturally and also politically.
Yeah, definitely. Well, so one thing, just the last pull out of the numbers. There has been a lot of focus on trade, trade war, and how that's impacting employment. The place that we do look to see that is, really in manufacturing. So we are seeing weakness in manufacturing, and maybe
but that's 9% of the.
That was going to be my point, right?
Yeah.
So it's another note of for all the time that we spend on trade and the trade war, we are not a particularly open economy. No, I mean it's very hard for very large economies to be open. I mean to be that open because their internal markets are so big that you could be a really successful company here in the United States and never look to a foreign market because we have a very rich open internal market.
Yeah.
So
and especially now where we found all the oil in the shale patch,
Right.
and
So-
also we can produce all our food if we want to.
yeah, so you pull that out of the trade numbers also. So we don't we actually don't trade all that much.
No.
The trading we do though is manufacturing. Most of the manufacturing story though is less about trade and competition than it is about technology and applying technology and techniques to the manufacturing
And to that point,
process.
when you look at S&P 500 earnings expectations, we're still expected to grow about 6.5% in the fourth quarter and 7% in the first quarter of 2020. So these growth fears that are being felt by policymakers aren't necessarily being reflected.
That was going to be my
in
question for
market
you guys.
expectations.
So if we say that so the tradable sector in the United States is relatively low, manufacturing is relatively small, and that's the place where most of the impact is. So why is the Fed so focused on the trade war and the global economy if that doesn't really affect the domestic economy all that much? Or maybe I'm understating it.
That's a very good question, Tony. That's a very loaded question.
So at some point, I will get everyone but the FOMC to agree that we really oughtn't be lowering rates right now. There's really no great reason for it.
Other than complete fear of a global depression driven by trade, which the odds, I would say, are relatively low.
Yeah. All right. Why don't we take a break right now? You're listening to the HPS Macrocast. Tony Fratto with Hamilton Place Strategies, John Fagan and Brendan Walsh with Markets Policy Partners. We'll be right back.
Are you or do you know a college student graduating this coming year? HPS is hiring. If you're interested in politics and public affairs and want to work in an engaging and fast-paced environment, be sure to check out HPS's entry-level associate and analyst program. Go to hamiltonplacestrategies.com/careers or email careers@hamiltonps.com for more information.
Okay, we're back on the Macrocast. So, summer's over. Everyone's back to work post Labor Day. There was this weird doom and gloom, which people keep looking to see show up in the jobs report, which is we just said we don't really see. But maybe better news this week. Maybe there's a silver lining around the dark clouds that have been hovering. John, what's your read?
Absolutely. That's the tale of this week. It's traders got back to their desks on Tuesday after the long weekend, and it was not a pretty picture necessarily. Not the kind of inbox you want to get back to. It was the trade. Lots of heightened concerns about the trade war. No confirmation that the Chinese were going to be coming in September as had been tentatively scheduled. There was heated rhetoric. The Trump administration had just imposed additional tariffs as of September 1st. There was some hope, and actually, pretty meaningful hope, that those would be postponed at the last minute as a gesture of good faith. That didn't materialize, and we had consistently worrisome price action, elevated but not horrible, but elevated volatility in equities. We had the dollar, an index of the dollar at multi-year highs, closing in on a 2-year high. The pound, as the ship of state veers toward the shoals of hard Brexit, and we had, Hong Kong aflame, and we had all sorts of
That was pretty ugly.
uncertainty and bad news.
Yeah.
Treasury yields, safe haven assets Treasury yields were plunging as investors sought safe havens. And we had an inverted yield curve blaring a recession warning. It was a pretty nasty combination. And, equity markets opened understandably with a thud on Tuesday morning, and then the clouds parted. It was an absolute a series of fortunate events, as we would to tweak the famous title. We had it all of a sudden. The optimists went on a big winning streak, and it started with. Really, it started with Wednesday morning. Everyone in the U.S. woke up to the news that the Hong Kong leadership were pulling the controversial extradition bill, which had initially sparked the protests way back in March. And this extradition bill was, basically, if you were arrested in Hong Kong, you could be extradited to the mainland and face trial there, where your expectations of legal protections are not close to what they would be if you were tried in Hong Kong. And that was, seen as a great erosion of the one country, two systems, and it brought people increasingly out on the street.
Which but it's a legal agreement between the Chinese and the UK and over how the Hong Kong would be handed over to the Chinese as part of a legal agreement. I don't know how you enforce it, but it is they do have a contract.
Lots of analysts thought that the Hong Kong government was going to pull it. When the protests really started to heat up in June, they thought that this was it was a bargaining chip. They would test, they saw the reaction and pull back. Well, they waited until now, and we certainly heard this from the protest leaders in Hong Kong that it was too little, too late. Maybe that's the case, but certainly the markets took it with a great sigh of relief. Some a measure of de-escalation in hopes that the worst case scenario outcome that everybody feared could occur in Hong Kong at any moment. It was diminished greatly, and Hang Seng, the local stock index, rallied almost 4% on the day, and it just gave everybody a better outlook. It just brightened everything up, and to have that sort of kickoff Wednesday, we got a combination of other things going on already. Parliament, we talked a lot last week about Prime Minister Boris Johnson engineering that controversial suspension of Parliament to try to knock his opponents off their tactics and strategies to try to block him. But Parliament, his gambit really sparked furious response in Parliament, and by Tuesday and Wednesday, the votes were coming through that would, basically require him to have to seek a 3-month delay in mid-October if there's no deal by then, and other ways to force him to take hard Brexit off the table as an option. He threatened a general election. Parliament is in the process of rejecting that.
Yeah.
This specter of a hard Brexit, a no-deal Brexit, very disorderly circumstance potentially on October 31st was diminishing around the same time.
It could still happen, but
I thought of you, John, when this was going on, because in your old job you would have to look at the markets and then walk up to the Treasury Secretary or potentially the White House and say, this is what happened. And then if the president asked, why did it happen, you'd have to explain. So if you had to go into Boris Johnson's office and you said, the pound rallied today, and if you ask why,
you were defeated. You were brought to heel by Parliament. So the currency rallied. Yeah, the pound popped 2% over the series. It came off, some perilously low levels, and is still holding those gains. We also saw on Wednesday night, we saw the long-awaited confirmation of the Chinese trade delegation. It didn't happen for September because of scheduling issues, but it's on train for it's basically set in for October. That was a huge relief. There was lingering concern that this might get pulled, and that the White House brinksmanship might have created caused a serious breakdown in these talks and these negotiations. But with the Chinese coming to town in October, and it was surrounded by some pretty constructive rhetoric on both sides, that hasn't failed to boost market optimism and buoy equity markets, and it dutifully did exactly the same thing.
And this was kind of previously the market had just kind of focused on the Trump side of the negotiations. I think this was the first time that the market had priced in maybe the Chinese are just going to walk away no matter what. So I think that rally was both the de-escalation, but also that China is actually willing to come back to the table.
Yeah, we've seen this a number of times now through the U.S.-China saga. Just anytime the arrow looks like it's pointing back towards talks and potential agreement, the market is reacting very positive. So even what we said earlier about manufacturing being a relatively small share of the market and tradable sector really relatively small part of U.S. GDP. That said, some really big important companies that make up big chunks of the S&P and the Dow are companies where their profits are dependent on trade and cross-border activity and are impacted to a great degree by the trade war. And so that's where you see a sort of maybe a not a tight correlation between market activity and economic activity for the broader U.S. economy. So it is important from a market standpoint. And so any little bit of relief that things are going to get pointed into a better direction, the market is reacting very, very positively.
Yeah, sure. And you can still, you can be tactical about it if you're in the equity market. You can avoid the companies with a really big exposure that in the last earnings season and previous earnings seasons have said the tariffs are hurting them, like Caterpillar.
Yep.
And it hasn't been consistent. Some corporation, some management where you think the company might be really taking the brunt of some of these things, like Walmart. The CEO came out and said it really wasn't impacting their business in a meaningful way, which is kind of surprising. But
Target took a very unprecedented act this week. They sent out a letter to all of their suppliers saying that if prices are going up because of the tariffs, you're going to eat it. We're not passing it on to our consumers.
Right.
So those guys, those very, very large players, they have the power to do that and to squeeze their suppliers. But you don't know where that end of that road is.
Right.
That's true. If there's a decisive breakdown, Apple, for instance, had a really nice second quarter, and management specifically said we did quite well in China. Well, Beijing doesn't have to let them have a good third. They can deliver a pretty lousy quarter to Apple if they felt like
there were
a really serious breakdown in the talks. And the Chinese just haven't gone there. That boycott, they haven't pulled that card out yet.
Yeah.
Some other stuff that we saw: the Chinese central bank eased policy overnight. That was not a big surprise. It was recommended by the cabinet, and they cut reserve requirement ratios, not the policy interest rate, but the amount of capital that the proportion of capital that banks have to hold in reserve. And by freeing that capital up, the banks can presumably lend more, and it's a credit-driven economic engine over in China to a great degree. And so that gave a little bit of a lift this morning. And actually earlier in the week, we saw Chinese manufacturing data that wasn't as bad as expected.
Right.
So this was a real winning streak for the global macro backdrop that looked so fraught and dangerous even as recently as Tuesday. Now, none of these are definitive solutions, but they are all positive.
They're the kinds of things that could, as we've seen, could go in the opposite direction on a week-to-week basis. But there was a confluence of them. I think if you're in the markets this week and looking ahead to the next week, you're probably feeling pretty good about the direction things are going.
A lot better than you felt on Monday.
Yeah, for sure. So I think it was probably a good week for you that way. Okay, why don't we let's break. We'll come back and look ahead to next week and see what other corners of the macroeconomy we should be paying attention to. This is the Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, we're back on the Macrocast. Brendan, what's the data we're looking at next week?
So the focus, we get the August consumer price inflation, which is always a big one for the Fed, part of their dual mandate. But the most important is the U.S. retail sales. Last month, it was up a lot, 0.7%, but that was mainly because July had Amazon Day. So people really love buying stuff on Amazon Day.
I'm a Prime customer. I can't.
Yes, I know.
Yeah, I use it.
It's hard not to.
Yeah.
Especially when they deliver it for free.
Yeah.
And then also we've seen some cracks in the consumer sentiment in the last few reports. So on Friday, people will be paying close attention to the U.S. Michigan sentiment. But the big event of
actually, I'm going to put a plug in there too for the HPS Consumer Sentiment Index too, and so we've been out already showing I think a real decline in consumer confidence
I think
right
it's
now. And
genuine this time, and we're coming from all-time highs, but it's certainly something to put on policymakers' radar.
Yeah.
But the big event is the ECB policy decision. This will be Mario Draghi's final meeting. At the last one, they held, but they kind of set it up for some big acts this week or next week. John, Tony, what do you think is going to happen?
Well, the European Central Bank is it's teed up. Rhetorically, it's teed up some easing, and that is reflected in markets. Markets are reflecting 100% odds of another rate cut. Policy rates are already negative 0.4%, and there's a 100% chance of at least a 10 basis point reduction in that to negative 0.5, and about a 50-50 shot of something more aggressive, 20 basis points to negative 0.6. Now, this is there's a lot of commentary.
There's small numbers, and so
if negative 0.4 wasn't really floating your boat, then can I interest you in negative 0.6?
Yeah,
it seems like
buy a boat.
It seems as though markets are putting that in because nobody's necessarily all that excited about rate cuts at this level, and it's proven to be pretty challenging for the banks. European bank stocks have really lagged this year, and because it compresses their net interest margin, and so on and so
especially forth. European banks.
Yeah, it's really rough for them. The big question is really whether they're going to augment their asset purchase program, so-called quantitative easing or QE. And they purchase primarily sovereign bonds across the EU in basically preset kind of ratios. And the expectation had been, Mario Draghi had sounded pretty concerned in his recent speeches. And there's a sense that given that he's on his way out and he's going to be succeeded as of November 1st, I believe, by Christine Lagarde, who's coming from the IMF, he wants to set her up. If he's got to make some difficult decisions and some big policy choices, he doesn't necessarily want to leave it to her.
That's a great point.
On her first meeting,
right? And so he ought to go out with a little bit more aggressive easing potentially than he might otherwise do. So quantitative easing, an increase in the monthly asset purchases is what people are expecting or had been expecting until pretty recently when we had pushback from the typical hawks, the Northern European Bundesbank, Weidemann, and so on and so forth, talking about how quantitative easing wasn't necessary at this stage. And markets didn't necessarily, the commentary from analysts was, well, yeah, if you're losing the argument, then you come out and start making your case in the media. And some of the other hawks were in the same boat. But then the head of the French central bank came out and made similarly non-committal comments on quantitative easing. And that gives a sense that maybe the centrists on the committee are slipping as well.
It sure seems that way. I mean, look, if you'd asked me in the spring, would we still be talking about it just a possibility in September? I'd say no way. Like they're going to get.
They already did it.
Yeah, and there's so to me, given the fact that the policy rate is not going to be very powerful for them, they need to be doing something different, and the national governments, are still not in a position. In fact, I want us to find time in the future to talk about this real problem, right? Because I think we definitely have smarter central banking now, I think, around the world, and they use all of their tools better, and they've conquered inflation. Maybe they've gone too far in conquering inflation, people don't know that inflation used to be a problem, and that's not that kind of problem anymore. But this disjointed relationship between fiscal authorities is a real problem when you're trying to deal with these kinds of growth output slowdowns.
Yeah, if your central bank is the only one that's answering the urgent call for stimulus, then you end up with what we have in Europe, which is extreme monetary policy settings. Yep. And there's a sense, the typical formulation for risk asset markets is more easing equals higher stock prices, better risk asset. It's a supportive of asset prices. Yeah. But in this case, actually, having the French central bank head back off of QE actually was not bad for risk assets. We've seen, a lot of concern about this race to the bottom idea. Yields are at record lows. We've talked about the entire German Bund yield curve being negative. Yeah. And there was a sense that maybe central banks are helping so much it hurts. Yeah. And
before QE, there was 600 million euros of available German debt that could be publicly traded. Today, that's only 70 million. So there's just none out there, basically.
Yeah. All right. Well, next week we'll take a look at ECB and spend a little bit more time in Europe and see what they will be doing and what they ought to be doing.
Exactly.
Have a great Friday, great Jobs Day Friday. Thanks from all of us here at the Macrocast, Tony Fratto at Hamilton Place Strategies, John Fagan and Brendan Walsh with Markets Policy Partners. We'll be back with you next week. Have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter at Tony Fratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.